Hey, how y'all doing today? Welcome back to the channel. I am Jeremy. I'm the Stock Brother, and you are on the Stock Brother channel. Today I have a good one for you. A lot of people have been asking me about how to value companies and which companies to pick. Is this company cheap or is this company expensive? How do you know? I get a lot of questions in regards to this and get into a lot of heated discussions over in my neighborhood about whether this stock is cheap or whether this stock is not cheap. And so today, what we're going to do is we're going to go ahead and try to break down some different multiples or a particular multiple. It's called a PE ratio. That's what we're going to be looking at. There's a couple different variations of this PE ratio, but we're going to get into that today and see if we can try to get this explained a little bit better, broke down a little bit better for you today. So again, welcome back to the channel. If you like the content, please subscribe. I appreciate all of my subscribers, everybody who has subscribed, and the future subscribers. So like it, share it, and thank you very much. So let's get into this. A PE ratio. What a PE ratio is, or what it stands for, P/E ratio, is going to be price to earnings ratio. And when it comes to this price to earnings, again, that's just one multiple that we use, or one ratio that we use in order to try to value companies. And there are a lot of different ratios, a lot of different things that you can use. There's not one specific thing that will allow you to get the exact value of a company. You have to take a multiple of different things in order to try to gather a better idea of whether this company is expensive or whether it's cheap. So first of all, the way that you calculate a PE ratio, and I'm going to give you an equation right now. The way that you calculate a PE ratio is going to be by taking the stock price and dividing it by the EPS, or the earnings per share. If you don't know what the EPS is, or earnings per share is, you can go check out a video that I just dropped this week, I believe. It's over in the What Is series, and What Is EPS is the name of the video. And that's basically going to be earnings per share, just to give you a quick idea of what that is. It's going to be the earnings per share. So, but today we're talking about PE ratio. So when you get ready to calculate the PE ratio, you're going to take the stock price and you're going to divide it by the EPS. That's going to give you your PE ratio, or PE multiple. First of all, the higher the PE ratio, the more expensive the stock is. And the reason why I say that is because basically what this PE ratio is, in layman's terms, just to try to break it down and tell you exactly what it is, it's basically how many dollars do you want to pay for every $1 of earnings that company makes. For example, let's just say that this particular company that we're looking at has a PE ratio of 15, right? Now, if the PE ratio is 15, that means if you buy that stock right now, you will be willing to pay $15 for every $1 of that company's earnings. Again, if the ratio is higher, if it's the PE ratio is 20 or the PE ratio is 30, that means you're going to be willing to pay either $20 or $30 for every $1 of that company's earnings. So that's how the PE ratio kind of works. So when I say that, it should give you an idea of why a higher PE ratio is more expensive. So in the same case, if you did have a stock that had the same price on it, two stocks, same price of $20 a share. If one company is $20 a share and you are paying a PE ratio and it has a PE ratio of 30, that means you are paying $30 for every $1 of earnings for this company. A whole nother company that has the same share price could be trading at a PE ratio, or price to earnings ratio, of 10. Which means you're only paying $10 for every $1 of earnings for that company. So when you think about it from that particular perspective, the stock price itself doesn't really mean anything. So when someone tells you I only buy stocks, or I get this all the time, I only buy stocks under $5 or under $10. Just because it's a $5 or a $10 stock does not mean it's a better value Would you rather pay $30 for every $1 of earnings of a company? Or would you rather pay $10 for every $1 of earnings for a company? So that's kind of how you look at it when you talk about the PE ratio and whether to decide if a company is cheap or whether it is expensive. Now, there are some other different ratios when you talk about some other different variations of a PE ratio when you talk about PE ratios. One variation is going to be the TTM, or the trailing 12-month PE ratio. Now, when you talk about the TTM or the trailing PE ratio, the way the trailing PE ratio is calculated is by taking the stock price right now and dividing it by the EPS for the last 12 months of the company. So this is an actual number that you can get. You can get it from the investor relations page of the company. They will have all of these things available for you to be able to find. So you can kind of Google it. Whatever platform you're using, they will have this information on there as well. Another variation of the PE ratio, or the price to earnings ratio, is going to be the forward PE. Now, the forward PE is not an actual number. The trailing PE, of course, we had an actual number because we were talking about what happened the last 12 months. When you talk about the forward PE, there are a couple of things that are involved in this, and most of it is all estimates. So you have your analyst estimates that are going to be considered in the forward PE. You also have the company's guidance. And guidance is basically what the company said they think they'll do. So the way that you're going to calculate the forward PE is basically by taking the current stock price and you're going to divide it by EPS estimates, or what the analysts say the estimated EPS, or earnings per share, is going to be in the next 12 months. So in the 12 months in the future. So when you talk about a trailing PE, it's going to be the 12 months that already happened. We have an actual number for it because we know what the EPS for the company was for the last 12 months. When you talk about the forward PE, that's basically that's an estimated number. That's the estimates of the analysts to try to figure out what the EPS is going to be between the estimates of the analysts and the guidance of the company. So those are a couple of different variations of PE ratios when you talk about the actual PE ratio for right now, when you talk about the TTM, or the trailing PE ratio, and also the forward PE, or the forward PE ratio. So those are the three kind of different variations of this to try to give you an idea of where the company was and where the company is going. Now, when you talk about using these in order to value a company, the best thing you want to do with these PE ratios is compare them. You want to compare these PE ratios to the PE ratio of the company for the last year, or the last 3, 4, 5 quarters. See exactly what the company was trading at, PE ratio wise. When you talk about the forward PE and when you talk about the trailing PE, it will give you an idea, if you look at the last year or so, where the PE ratio was trading at and where it is now. This will also give you an understanding of how to value this company based off of what it's done in the past. Another way to use these ratios in order to value a company, to find out if a company is cheap or not, you also have to compare the ratios when you talk about the TTM, or the trailing, and the forward PEs to other companies in the sector, in the same sector. Is there another company that does the same thing as my company does? And is it trading higher? Is there 5, 6, 10, 15 other companies in the sector? Most likely there are, that they trade at certain PEs as well. And the whole entire sector is what you want to basically compare the company that you're thinking about buying to the other companies in the sector. See, are the PE ratios for the sector very high? If you have a sector that has a PE ratio of 25 or 30, and the company that you're looking at has a PE ratio of 15, that gives you an idea that the company is trading cheaper than the rest of the companies in the sector. So when you talk about the PE ratios, it gives you a great idea of, is this company cheap? Is this company not cheap? Company could have the exact same price on it, and one be trading way more expensive than the other. One has a 45 PE ratio and the other has a 10. So you kind of have to be aware of that. when it comes to being able to value these companies, and you kind of have to go from there. Now, what you have to be aware of is that sometimes when these companies have very, very cheap PE ratios, or very, very low PE ratios, you have to really take another look at the company. Again, this is not the only metric that you need to use in order to value these companies. You have to look at other things. Some of these companies have actual fundamental changes to their business. Some of these companies are going down. Some of these companies are not going up. Some of them have already been up. If you look at the stock price and look at where it used to trade at, they've been up very high. And for example, a stock used to trade at $50 a share, and now it's trading at $10 a share. And you look at the PE ratio, and you're like, goodness, this PE ratio is cheap. This stock is cheap. I better buy this stock. Well, there's a term in the stock market that we like to use to define these particular type of companies. We call this a value trap, is what we call this. You have to be wary of value traps. Just because a PE ratio is low and a stock is cheap does not mean that it is a buy. It could still not. It could be a hands-off, I'm not touching you type thing. When you talk about some of the different companies, and just because it's trading at a cheap value or a cheap PE ratio does not mean that the company fundamentally is going to do well or going to do better. So it does not mean that a company is a buy just because it's cheap. Don't get caught into these value traps and buy the stock and you think it's a cheap stock. I bought it at a good price, but the stock is really going down. From a fundamental standpoint, or there is something, maybe another business is disrupting their business. So you have to take a well-rounded view of a company and gather your own idea of whether this company is a buy for you or whether it's not. One other thing that you have to keep in mind is if a company does not have a PE ratio, or if they have a NA or not applicable on their PE ratio, when you look at the metrics of that company, it means a couple of things. Either that company is very new or brand new to the stock market or just started trading on the exchange or on the market, or the company is not profitable, which means, in order to get a PE ratio, you have to be a profitable company for at least 4 quarters. So if you don't have a PE ratio or you haven't been profitable for 4 quarters, then you might not have a PE ratio. That basically means either you're not making money or you're losing money. So you have to be aware of that as well. If a company does not have a PE ratio, more than likely they are not a profitable company or they are very, very new to the market. So keep that in mind as well, you all. So I hope this has given you a little bit of a better understanding in regards to PE ratios, into the trailing PE ratio for the last 12 months and forward PE ratios. Those are going to be major when you talk about valuing companies. Again, the higher the PE ratio is, the more expensive the stock is. That's more dollars you are paying for every dollar of earnings of that company. So you want to kind of take a look and make sure that your PE ratio is at a good value. So make sure you compare it, make sure you do everything you need to do and do your due diligence, do your research before you buy these companies. So that being said, I hope you have gotten a lot of value out of this video here. I want you to please smash the thumbs up button. And you all also have some links down in the description there that you can use to get started in the stock market. Most definitely, those are there for you. Go ahead and hit the link. They'll give you a couple of free stocks or either give you a couple of dollars when you sign up and when you deposit some money into your account. So don't hesitate to use those links. And thank you all for coming in today for the video. Thank you for watching the whole entire video. And I'll see you next time. Bye-bye.